Finance, a comprehensive and organized overview. 1. Introduction to finance. Finance refers to monetary resources and the academic discipline concerned with money, currency, assets, and liabilities. As a field within business administration, finance involves planning, organizing, leading, and controlling financial resources to achieve organizational and economic goals. It plays a central role in decision-making for individuals, businesses, and governments. Finance studies how funds are raised, allocated, invested, and managed over time under conditions of uncertainty and risk. 2. Financial systems and instruments. The financial system facilitates the flow of capital between savers and borrowers and includes financial markets, institutions, instruments, and regulations. 2.1 Financial instruments. Assets are traded in the form of financial instruments, such as currencies and deposits, loans and mortgages, bonds, government and corporate, shares and stocks, derivatives, options, futures, swaps. These instruments help entities raise capital, manage risk, and allocate resources efficiently. 2.2 Role of financial intermediaries. Financial intermediaries such as banks, investment banks, mutual funds, pension funds, and insurance companies connect savers with borrowers. They accept deposits and provide loans, facilitate investments in securities, manage risk and liquidity, earn returns through interest spreads and fees. 3. Core areas of finance. Finance is broadly divided into 3 major areas based on the scope of activities. 3.1 Personal finance. Personal finance deals with individual and household financial decisions. It focuses on managing income, expenses, savings, investments, and protection against risks. Key components include budgeting and cash flow management, saving and investing, insurance and risk protection, tax planning, retirement planning, debt and credit management. The objective is to achieve financial security while balancing risk and return. 3.2 Corporate finance. Corporate finance focuses on how firms raise and use capital to maximize shareholder value while managing risk. Main objectives: maximizing firm value, optimizing capital structure, ensuring liquidity and profitability. Key functions: capital budgeting, evaluating and selecting long-term investment projects. Capital structure, deciding the mix of debt and equity financing. Dividend policy, determining profit distribution to shareholders. Working capital management, managing short-term assets and liabilities. Corporate finance is closely linked with investment banking, financial markets, and risk management. 3.3 Public finance. Public finance deals with the financial activities of governments and public sector institutions. It includes public expenditure management, taxation and non-tax revenue, budgeting and fiscal planning, public debt and bond issuance. Central banks play a critical role by influencing monetary policy, interest rates, and credit conditions. Public finance also includes development finance, infrastructure financing, climate finance, and public-private partnerships. 4. Investment management. Investment management involves professional management of assets such as stocks, bonds, real estate, and alternative investments to meet specific financial goals. Key concepts: asset allocation, portfolio diversification, risk-return trade-off, active versus passive investing, analytical approaches, fundamental analysis, valuing securities using financial and economic data, technical analysis, forecasting prices using historical data, portfolio optimization, selecting efficient portfolios based on risk preferences. Quantitative and algorithmic strategies are increasingly used in modern investment management. 5. Financial risk management. Financial risk management focuses on identifying, measuring, and mitigating risks that threaten financial stability. Major types of financial risk: credit risk, risk of borrower default; market risk, risk from changes in prices, interest rates, and exchange rates; operational risk, risk from internal failures or external events. Risk management uses tools such as hedging, diversification, insurance, value-at-risk VAR, and stress testing. It is essential for banks, corporations, and insurance companies. 6. Quantitative and mathematical finance. Quantitative finance applies advanced mathematics, statistics, and computer science to financial problems. Key areas: derivatives pricing and financial engineering, risk modeling and regulatory capital, algorithmic and high-frequency trading, quantitative investment strategies. Important mathematical tools include stochastic calculus, optimization simulations, and partial differential equations. The Black-Scholes model is a foundational contribution to this field. 7. Financial theory and economics. Financial theory provides a conceptual foundation for modern finance. Financial economics. This branch studies asset pricing, market behavior, and capital allocation under uncertainty. Key theories include modern portfolio theory, capital asset pricing model, CAPM, Modigliani-Miller theorem, efficient market hypothesis. These models explain how prices are formed and how risk is priced in financial markets. 8. Managerial finance. Managerial finance focuses on financial decision-making from a management perspective. It supports managers in planning and controlling financial resources, evaluating performance and profitability, aligning financial decisions with business strategy. It integrates corporate finance, managerial accounting, and strategic management. 9. Behavioral and experimental finance. Behavioral finance. Behavioral finance examines how psychological factors influence financial decisions and market outcomes. It explains deviations from traditional rational models due to biases such as overconfidence, herd behavior, loss aversion. Experimental finance. Experimental finance uses laboratory experiments and simulations to test financial theories and observe real decision-making behavior in controlled environments. 10. Emerging areas. Fintech and quantum finance. Financial technology. Fintech. Fintech has transformed financial services through mobile payments and digital wallets, peer-to-peer lending, blockchain and digital assets, AI-driven financial analytics. Quantum finance. Quantum finance applies concepts from quantum physics and advanced computation to solve complex financial problems, such as option pricing and portfolio optimization. 11. History of finance. The history of finance dates back to ancient civilizations. Banking and interest in Mesopotamia, 3000 BC. Coinage in Lydia and ancient Greece. Roman laws regulating interest rates. First stock exchange in Antwerp, 1531. Emergence of modern financial markets in London and New York. In the 20th century, finance evolved into a distinct academic discipline with formal theories, models, and professional education programs. 12. Conclusion. Finance is a broad and dynamic discipline that underpins economic activity at every level. From personal financial planning to global capital markets, finance enables efficient resource allocation, risk management, and economic growth. With the rise of technology, sustainability concerns, and advanced analytics, finance continues to evolve as one of the most influential fields in the modern world.